Welcome back to The Climb. Last episode we covered the tax basics, the progressive tax system, brackets and rates, withholdings and filing status. Today we level up: intermediate taxes, deductions that lower your taxable income, credits that cut your taxable bill dollar for dollar, and smart strategies to make the most of them. This ties straight into your budgeting from episode 2 and the investment basics from episode 3. Let's get to it. Let's take our next step in The Climb.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.
Quick recap from episode 4. Progressive systems with rates from 10 to 37%. Brackets are adjusted for inflation. The standard deduction is $16,100 for single filers and $32,200 for married filing jointly. Taxable income is what is left after subtracting that. Now we go deeper: deductions and credits, and where most people save real money. The average refund is right around $3,000, but strategic filers keep more of their money all year long, not just in April. If you already have an emergency fund built, great, and if you're managing debt, that's even better. These tools speed up your climb. Now let's make this practical and clear. Let's continue with our ascent in the climb. Deductions reduce your taxable income. They lower the base you pay taxes on. There are two main paths: the standard deduction, which is what most people take, or itemizing, if your qualifying expenses add up to more than your standard deduction. Common itemized deductions: mortgage interest, up to a limit, usually around $750,000 of debt. Charitable contributions, cash or goods. Student loan interest, up to $2,500 maximum. Medical expenses, if they exceed 7.5% of your AGI or adjusted gross income. State and local taxes, SALT, capped at $10,000. There are also what is known as above-the-line deductions. You take these even if you use the standard deduction. Examples: educator expenses, up to $300. HSA contributions, traditional IRA contributions, only if you qualify. Here's a practical example. Suppose your AGI is $80,000 as a single filer. If you itemize $20,000, which is more than $16,100 of the standard deduction, you save about $900 in taxes, assuming a 22% marginal rate. That's real money right back in your pockets, right? So you itemize, you were thorough with this, and you didn't take the standard deduction, and the difference is $900 in your pocket. Credits are even better than deductions. They reduce your tax bill directly, dollar for dollar. There are two types: refundable credits, which give you a refund even if your tax liability is zero, and non-refundable credits. They only reduce your tax down to 0%. Key credits for many people: child credit, about $2,000 per child under age 17. There's a phase out starting at higher incomes of $200,000 and plus for single filers. Earned income tax credit, or EITC, for lower to moderate incomes. It can go around $7,830 with 3 or more children. Educational credits: the American Opportunity Credit, AOTC, up to $2,500. Lifetime learning credits, up to $2,000. Energy credits for home improvements like solar panels, which is up to 30%. These credits can completely change your tax return, especially if you have kids, educational costs, or home upgrades. Now, strategies to maximize everything. 1. Bunch deductions. Group one big expense into 1 year. For example, make a large charitable donation in 1 year and nothing the next. This way you exceed the standard in alternative years. 2. Timing. Control when income hits. Defer bonuses or sales if possible. Or prepare deductible expenses like property taxes. 3. Connect to episode 3 investing. 401k contributions lower your AGI right away. Roth IRAs give tax-free dollars and grow later. Use free filing software if your income is under $79,000, or use apps like TurboTax to guide you. Winners plan ahead and losers miss opportunities. Don't miss these opportunities. Understand how credits and deductions work. Work with your CPA, work with your tax specialist. Make sure that you're positioning yourself in the best possible way when you're declaring your taxes. So you itemize or take the standard deduction. That's a conversation worth having every single year with your tax specialist. Key takeaways today: intermediate tax tools deliver real savings. Here are 3 actions for this week. First, gather documents for possible deductions: receipts for charities, mortgage interest, statements, etc. Second, check if you qualify for things like child tax credits or EITC. Use free IRS online calculators. Third, think about bunching expenses next year. Could you move some deductions forward? In next episode, we go advanced. We talk about capital gains optimization, taxes for self-employed people, multi-year planning, and then we finally wrap up this great series with Richard Duran, our CPA, who's going to answer all questions regarding taxes. He's going to tie everything together and going to talk to us about the big, beautiful bill. Thank you for watching this episode, and we'll see you next time in The Climb.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.